Hi, I'm Mark Burgess, and I'm very pleased to moderate tonight's session, or today's session, on China. I mentioned tonight because I'm based in Melbourne in Australia, and we have a number of guests from across China who will be on the panel shortly. But I have a great honour in, first of all, introducing our guest speaker, William Ma. William, I'm sure, is very known to many of you, but has extensive experience across the region and comes to us from China. And we'll open up with a few opening comments on China to sort of really set the scene for us. And then I think we're going to have a very interesting panel to talk about the current state of the financial markets in China, but particularly the structure of China and the way it's beginning to develop, particularly for international investors. But I'll hand over to William and for your comments. Thanks for joining us, William.
Thank you, Mark. Hi, everyone. I'm William Ma, CAIA Global Board Member, Asia Pac Committee of SBAI, and also CIO of Grow Investment Group. I've been investing in China market for more than 20 years on behalf of global pension funds and institutions, and invested in over 200 hedge funds in the region. I'm fortunate enough to witness, if you like, the growth and the mature of opportunity of the China market. I still remember back in 2001, the China-Asia market cap was about $700 billion US, and it has grown to now 12.7 trillion US dollar. So it had increased by 17 times, over the last 20 years. And number of companies has increased from 1,000 to 4,400, which by 3 times. The current asset management industry back then was about 700 million. Now it's become a 10 trillion US dollar industry, of which about 2.9 trillion US dollar is in the hedge fund alternative investment industry, and 3.5 trillion, in the mutual fund industry. Just like any other country, sector, or company, there were ups and downs in the past 20 years. There were key milestones, there were new policy, there were new risks, and then new opportunities. And I still remember back in 2001 when China entered WTO, this is one of the key milestones, back then, if you like. And then we have the SARS period in which China was down 17% and MSCI World was down 24%. And then we have the 2003, the first QFII Connect program, in which allowing global investor to investing in the China market. I think this is a very big, milestone back then. And then in 06 and 07, we have a bull market in the China market, in which 06, the market was up 123%, and then 07 up 56%. So the unfortunate, global financial crisis hit, but at the same time, I think we got the first through chain program in which the Hong Kong Shanghai Connect, get connected, which is a good starting of the market, opening, if you like. And then we have the bear market in year 2010 to year 2013. Now in year 2014, we have the formal Hong Kong Shanghai and Hong Kong Shenzhen Stock Connect, in which a lot of global investors are start, increasing their exposure in the domestic China-Asia market. And that particular year, China market was up 46%, and the MSCI World was up about 7%. And then the recent development is, in 2018, we have the MSCI index inclusion on the equity side and also on the bond side. In 2019, we have the Star Board opening in the Shanghai Exchange, in which a lot of the tech companies are being listed in the, Shanghai market. And last year, we have the domestic mutual fund license fully owned by some, global financial institution. I think that is also a milestone for opening the market. And last year, under the COVID situation, MSCI World was up about 12%, and China market was up 29%. Again, those are the key event and milestone over the last 20 years. There is ups and downs, there are new regulations, there are risk and opportunity. So today's panel, I'm fortunate enough to have a very experienced people to explain, all those, background. So we have talked about what happened in the last 20 years. Maybe Mark, I'll hand over to you and to let the, honor speaker to talk about what would happen in the next 20 years. Over to you, Mark.
Thank you very much, William, for that oversight. I'd also like to thank Jim and Bruce, the co-founders of the Greenwich Economic Forum, for really including China always as a feature of the forum right since inception. And I think that's indicative really of the importance of China, as we all know, to the global economy, but also the importance of China to financial markets generally. In fact, what we've seen, as William was mentioning, both the development within China of the financial system, the style of assets, which we'll hear about shortly, but also the development of international investors' focus on China and, in fact, commitment of capital to China for a long-term investment play. Today, we'll talk a bit about the current China developments, but we particularly also want to focus on the long-term characteristics of China and the development of areas. And hopefully this is a kind of a learning for those who aren't that exposed to it, but for those that are very exposed to it, this is a chance to get some further insight. Well, I've got a great panel with us today. We've got Dr. Chenxi, Executive Vice President from Tianfeng Securities. Mr. T. Yu, who's the Managing Director of Markets of HKEX, and also Mr. Robert Zhang, who's the CEO of DH Fund Management. All have extensive experience, interestingly working in many markets across Asia as well as China, and I think we're in for a very interesting discussion. But perhaps to set us off with a sort of an overview, I might ask you, Robert, to perhaps give us some background, perhaps touch on some of the developments that have been focused on here at the Greenwich Economic Forum over the last 2 days and in the markets generally. But also, could you provide us with an understanding of the latest policies changes in China, and particularly the implications that they're having on economic fundamentals and financial markets? And I know this is an area that you do, particularly in the hedge fund area, but as a macro investor, are particularly attuned to. So could you give us some insights there? Thanks very much, Rob.
Thank you, Mark. Actually, I would like to talk about the current situation, in particularly, the policy changes in China from a top-down approach. Anyhow, DH Fund Management Company is a, global macro hedge fund. Regarding the policy changes so far this year, in particularly the policies regarding with some sectors, some individual companies, i.e. Evergrande, etc. We think it's only a continuation of the major key macro policies made by the decision makers in China in the past 5 or 6 years. The main target for those policies is to reduce the tail risk for whole system and increase or improve medium to long-term growth potentials. Those major policies are, supply-side structural reform being launched back to 2015, which include cutting excess capacity, destocking, deleveraging for corporate and shadow banking system, lowering corporate costs and improving weak links, and also the so-called three critical battles against the potential risks being launched back to the December 2017, i.e., reducing potential financial risks and targeted poverty alleviations and prevention and control of environmental pollutions. And lastly, the new regulations on asset management being launched back to 2018. Macroly speaking, all those macro policies, the target are to contain high debt ratio risk, property bubble risks, and containing local government debt. The new regulations on asset management is one of the key, the policy efforts to reduce solving shadow banking system risks. Actually, the transition period for this new regulation will be ended by the December of this year. So overall, those policies, those macro policies, in the short term, we think it will definitely put downward pressures on China's economic growth for this year and very likely next year due to its knock-on effect on property sector and infrastructure investment, and also increasing bad loans. But it's not a black swan. Actually, in addition to Evergrande, we have been seeing a few similar big debt restructuring since 2018. For example, like Anbang Group, China Huarong AMC, HNA Group, Baoshang Banks, Tianjin Iron and Steel, etc., etc. We think, for China's decision makers, they know this big potential risk. The main target is to contain this risk, reducing tail risk for the medium to longer term. And they have ample and policy room to deal with the situations, i.e. fiscal policy and monetary policies, i.e. just like what the PBOC did in this summer by cutting RRR to guarantee the banking system have enough liquidity to contain the likely impact from the Evergrande situation. But the bottom line is, no systematic risk. That's the bottom line. But in the longer term, we think, by reducing tail risk and promoting China to have a bigger and more resilient middle class populations will be the main benefits. For example, like this year, you can classify the policies into 3 categories, i.e. definancializing real estate industry, demarketization healthcare industry, and the decapitalization education industry. All these efforts will reduce, the expenditure cost for middle class populations in China going forward. And for capital market, that the policy changes will make China depend less on indirect financing system, but more on direct financing from capital market. It will for sure benefit asset management business going forward, because we don't have to have so much implied guarantee system for banking system and asset management business. So overall, we think, we need to look at the situation from a 5 to 6 year perspective. It's not a single individual situations. It's a continuation of the policies from past 5 to 6 years. That's from me.
Thanks very much, Robert. And I'd now like to move to Dr. G. As you were saying, Robert, the thing that strikes me, and I visited China first almost 40 years ago, dare I say, but really in the last 20 years in particular, policy strategies have really been laid out very clearly. Obviously, some errors get made and some changes need to be made as we go along, but China is very clear on the way strategy is developed. But Dr. G, I'd like to perhaps ask you if you could share with us your view on the recent changes in relation to Chinese regulatory policies, and really what significance do these changes mean for Chinese and international investors? Dr. G?
Okay, thank you. Thank you, Mark. Thank you for your question. So first, let me say it's great to join the forum today, right? Thank you very much. And as you have mentioned, there's a lot of regulatory policies recently, right? And it's very interesting, or how to say, it's quite pressure to the investors, right? So I'd like to share some points that I have observed. So I'd like to share some observation based on a few recent new regulatory policies. Okay, the first one I would share is that in September, the President Xi has announced to establish the Beijing Stock Exchange. It's a big news. And this news announced the setup of Beijing Stock Exchange as a primary platform serving innovation-oriented SMEs. So the establishment of Beijing Stock Exchange was made further to the incremental reforms such as Science and Technology Innovation Board. So it's a stock plus incremental reform, which is quite highly related with the economic reform of China. So this is the first big news recently. And the second point I'd like to share is about the Guangdong, Hong Kong, Macau, Great Bay Area. So from last year, the PBOC and the other 4 ministries and commissions jointly issued the opinions on financial support for the construction of the Guangdong, Hong Kong, Macau, Great Bay area. And there are about 26 specific measures related within this topic. And now in the September 2021, just the last month, the Great Bay Area Cross-Border Wealth Management Business Pilot Implementation Rules was issued. That means that will expand the cross-border financial investment products in the Great Bay Area. So that's a very, it's a very big potential area for the onshore and offshore financial products. We can buy each other. And the second one I would like to share is about the Rmb Internationalization Strategy. Because within the past 4 years, there's a lot of pressure during the globally, right? But now we can see some new signal. So with the China's capital market is continuing to open up, so access by foreign investors easily significant actually. Firstly, we can see the PBOC decided to lift the limit of the foreign shareholding, removing the quota restriction of the Q fee and RQ fee. And from the last year, the foreign ownership restriction has been totally removed. For example, in June, within this year, BlackRock obtained the #1 mutual fund license of the foreign investor, the first one. In about only 1 month, the BlackRock established a hybrid fund named the BlackRock China New Vision in China quite successfully. And another example is on August, JP Morgan announced that JP Morgan Chase Securities become a wholly owned foreign securities company in China. So to sum up, I'd like to say, I'm sure that though there are lots of pressure during US or China or globally, but the Chinese government is trying to keep opening their financial market. That will be more helpful for the foreign investor to come into. So I'll just share like this. Thank you, Mark.
Thank you very much, Dr. G. I had the chance to speak at the Bund conference around this time 2 years ago, and this development was being widely discussed. And of course, as you've just discussed there, JP Morgan and others are now taking advantage. So again, strategy very clearly laid out and now on a very clear path. Another area of clear path is really the access to the markets, and this is about the channels and the structure. And Tai, could you perhaps give us some insight into the Chinese access channels? What are the key choices available for investors? And also give us perhaps an update on the evolution of the Stock Connect program and where we are, perhaps the noticeable achievements and some of the areas of development that have occurred there.
Yeah, great. Thank you, Mark. So first of all, in terms of access channel, now global investors have a number of different choices to access and get exposure to Chinese capital market. Of course, in Hong Kong, we provide access for global investors to both access equity market as well as a bond market through both Stock Connect and Bond Connect. But from product perspective, one thing that has been interesting, and this is something that's been discussed in the beginning by Dr. Zhai as well as William, in a sense that in the most recent market events, there's a higher degree of demand for investors to manage risk. And manage risk certainly is an important element when investors invest into a Chinese capital market. And in Hong Kong in last month, and just following and supplementing to Dr. Z's point, that State Council and CSRC publicly endorsed Hong Kong Exchange to launch a pure A-share index futures on equities, and that we will be launching that on the 18th of October, together with Stock Connect as well as A-share ETF. Certainly, that's going to be an extremely important product for international investors to access in Hong Kong to be able to manage risk. That particular futures contract will be the only one offshore futures contract that CSRC has approved and endorsed, along with SFC regulator in Hong Kong. Now, overall, in terms of the progression of the investment, I can tell you that the fellow panelists have shared the market events have evolved different appetite of investment. but the speed to which investors have been investing in A shares has been increasing positively. So I can honestly say that we've now achieved over 150 billion average daily turnover, and this is daily on A share trading through Connect program. We're now accumulated over 2.5 trillion RMB worth of A shares through Stock Connect program held by foreign investors. And this is a stark achievement compared to 2 years ago. I can tell you it's double the size in both turnover as well as investment that's been invested through A share market. And that what we do look forward to is continuing to improve the program to be able to have the international investors to find very cost-efficient way, but also actively participate in mainland capital market. And certainly this new initiative that's been announced by the regulators and us to launch a new futures contract will go a long way in developing access channel to mainland capital market.
Thanks very much, Tai. You make some very good points there, particularly about how engaged international investors have been. There are some investors, though, that are cautious. There's no question about that, or beginning to learn about the market. Dr. Zhai, could I perhaps ask you about offshore investors engaging in the Chinese market, and some of them viewing it as challenging? Could you perhaps go through some of the areas that you see them being challenged in, and perhaps how they should think that through and perhaps come to grips with it, because it is an important market to be aware of?
Okay, thank you, Mark. So firstly, I would say we need to recognize the fact is that the Chinese government has carried out a series of kinds of the financial reforms and continue to focus on improving the regulatory system and trying to promoting the maturity of the financial market. But we cannot ignore the difference between the China and the West, right? So but we truly believe that the obstacles and the challenges the overseas investors faced in the emerging market, like Chinese market, will ease gradually. So now a few thoughts come to my mind include the following three, I think. The first one is that I would like to suggest that the foreign investor need to be more familiar with the Chinese laws and the different kinds of the regulatory new rules, right? And the transaction procedures in China is also quite different from Hong Kong and the West. So you need to be more familiar with this kind of the procedures before conducting the transactions locally and avoid violating the regulatory rules. But secondly, I would like to suggest is that because the Chinese culture is so different from the West, so if the foreign investor want to do some big business in China, that will be very, we need to recruit more local professionals which is very familiar with the local business. That would be much helpful. And then maybe they also need to cooperate with or acquire the local consulting and research service from some local financial institutions in China. That will be much helpful for the foreign investor to accelerate their adoption in Chinese market and help them to facilitate the transaction. But last but not the least is that maybe in China, I would like to suggest is that recognize that Chinese market is still in the process of the development. So some kind of the patience will be needed in the long term, in the long run. Okay, thank you.
Thanks very much. We don't have time today to go through, an extensive discussion of the products or the asset classes that are available in China. But it's worth following this closely, either as an investor because of the areas that you may want to place capital into China, but also because of the importance of a diversified financial system within China. And this has been talked about for some time, and it has been developing quite significantly in the past decade or so. So we're just going to touch on a couple of product areas, and this is just also to remind you that there's a chance to take some questions at the end today. You may have something on some specific areas, but we're going to talk on some specific products. But of course, there's development of things like private equity, infrastructure investing. We've talked today about listed equities, corporate bonds, government bonds. The market really has broadened out. But Robert, I might turn to yourself. You're a kind of leader in the hedge fund industry. Could you give us an insight into the latest developments there and how the hedge fund sector is developing within China?
Yeah. Sure. Actually, as I just mentioned, the macro policy, in efforts restructuring China's economic growth drivers and financial market has been benefiting, capital market a lot, in particularly asset management business. As for, hedge fund sector, actually the Chinese government legalized this sector in 2013. So, for this sector, the history is less than 10 years. But back to the 2014, the total AUM for hedge fund sector in China is only ½ trillion RMB. But by the end of the first half of this year, right now it's 5.5 trillion RMB. In just 7 years, the period, it's grown by more than 10 times. So this is a total AUM. Actually, because of the this is not only for hedge fund sector. I think it's also for asset management business overall, because of in the past 20 years, the property sector, real estate industry is a single biggest sector absorbing, liquidities for whole system. But because of this supply side restructural reform, actually the capital market is absorbing more and more liquidities. And for mutual fund, actually in the past 5 years, because this year is 14th 5-year plan, the first year of a 14th 5-year plan. Actually, for the past 5 years, the total AUM for mutual fund industry in China also grew by something like 1.6 times. So it's also a big, a significant growth. And so for the first half of this year, hedge fund total AUM for hedge fund sector grew by another around 28%. So, if you look at China's GDP growth, it has been slowing. But if you look at asset management business, it is booming. And in addition, the strong growth in AUM, actually the hedge fund sector has been showing some sign, some development stage, like what has been happening in hedge fund sector globally, i.e. since 2000 until right now, more and more fund flow going to, bigger market player. And, for example, like by the end of 2018, the top 100 hedge fund managers, they account for around the 39% of total AUM for the hedge fund sector in China. But by the end of the first half of this year, right now, top 100 hedge fund managers accounts for around 55% of total. You can see, both whole sectors and the bigger, the managers has been getting bigger. So, we're looking forward, for the next 5 or 10 years because of the ongoing policy changes and further capital market reform. The strong growth is going to continue for the next few years. Yeah.
Thanks very much, Robert. As you mentioned, there's been a lot of development, and I'm particularly struck by the way the development, when there's a setback, rules get changed, restructured and reset to improve the sectors. But an area that's been around for some time and is very well known by foreign investors is the A-share market. Ty, could you give us an insight there into the way foreign ownership of the A-share market's been developing and just what trends you're seeing behind that?
Yeah, absolutely, Mark. And just following up to Robert's comment, the A-share market has been really welcomed by international investors through Stock Connect in particular. Now, A-share market access by foreign investors market share is 70%. And this is only short 7 years ago when we started the Connect program, and it's just continuing to expand. Just to kind of add a couple of points there, what investors are telling us is few points. First of all, if you really go back to, and this was Robert's point, 14th five-year plan, there are a number of different policies that are ongoing and developing, in particular with aging population, carbon neutrality, especially with the wealth transfer from older generation to younger generation in the form of pension development. All of these elements really trigger capital market development for the longer term. And in particular with the new economy sectors, policies really provide support to development in healthcare sector, development in service sectors that really have a robust growth and investment opportunities for investors. And on that point, MSCI, working with us, have announced jointly together with a new product that really reflects this very interesting investor demand into new Chinese economy. As I said earlier, there's over 150 billion daily trading turnover on northbound Stock Connect. More than 60% of that volume goes to Shenzhen Stock Exchange. And that Shenzhen Stock Exchange represents broad-based exposure to Chinese new economy, such as healthcare, green industry, as well as IT. And that with us, the MSCI China A50 index was announced by MSCI. And that's the future contract for risk management purposes that we're launching with the regulatory approval on 18th of October. One thing that is interesting about the reflection of the Chinese new economy always has been that the growth driver of the secular trend and rotation development around the new economy centers around where the 14th five-year policy is focused on in terms of implementation. And certainly the new economy sectors and the products that's going to be available for investors will need to reflect that. And I think MSCI has done a really good job in developing that product. As a result, we'll be working with them launching this product on futures contract.
Thanks very much, Tai. I can encourage you to send questions through the chat box. I might just give you a follow-up question if I could, Tai, perhaps based on not following the market that closely, but this is perhaps also not an unreasonable question for people to ask. Could you just give us a sense for the role of capital markets now in China? I think some people are misinterpreting that China is unsure about its role of capital markets, but I guess you've already answered this. But could you give us a sense for what the trend and the direction is and what the role of capital markets will be, particularly in those kind of emerging and developing sectors?
Sure. So from access perspective, capital markets provide an important conduit and channel for international community to be able to participate in the growth of many of the economies in China. And that's the important point. The objective of Connect program in both Stock Connect and Bond Connect is to allow international investors to have easier access to mainland capital markets. And the objective really there is to increase foreign investors to participate in investing the growth of the Chinese economy for the longer term. And as part of that equation, it is also extremely important for Hong Kong to play a role to support that particular initiative. And this is why when you have a new initiative that always develops, Hong Kong always plays an important supporting role to that. And of course, Stock Connect program being extremely successful now, with over 70% of foreign holding of A shares, Bond Connect is just as exciting. And don't forget, there's another interesting element for global investors to consider. This is about mainland capital investing in overseas market. When you look at the growth of southbound Stock Connect, we've now achieved over 2.5 trillion Hong Kong dollars worth of southbound investment by mainland investors in both institutions and retail. And we just announced southbound Bond Connect just a few weeks ago with mainland regulatory approvals. And the direction of the travel here it definitely is, Mark, that China is opening up, capital market is expanding, there are so many choices now for investors to consider. Certainly, it complements the overall objective that China is open for shop and investment, and that investors can participate in the growth.
Thanks very much, Tai. Dr. Chi, I'd like to now sort of move to perhaps the attractive areas, and you'd see this in your firm in terms of attractive areas or areas that your firm considers to be attractive. Could you perhaps point out some of the opportunities in the Chinese financial market, and if you were to pick sort of one area that has the greatest growth opportunity currently, where would you be pointing people towards?
Oh, that's a relatively tough question, because there are so many actually attractive areas in China that offer growth opportunities. But if I can only focus on one area, I would recommend the asset management and the wealth management field. Okay, let me try to elaborate some of the rationales behind my pick. Okay, firstly, it has the very strong policy support from the government. Just as Robert has mentioned before, 3 years before, from the 2018, the new asset management rule of China has launched. So during the past 3 years, a new stage in China has opened. The new stage has been set for the industry. The business is being transformed totally to the net value based, the true asset management business. It's quite different from before. Before, the asset management in China was dominated by the banking system, like the rigid payment expectation scheme, which is quite different from now. So the overall brokerage asset management products have been shifted, transformed to the mutual funds, investment in bond, in stock, in a secondary financial product, etc. So that's a very big change during the past 3 years. Secondly, the reason is that there's a very large growth potential. The reason we can discuss, we have mentioned before the housing finance industry, right? Like the Evergrande, lots of the foreign investor has a lot of the discussion about the financial industry and the real estate industry. But there's a key point behind the real estate industry is that the money of the local inhabitants shift from the housing assets to the financial assets. That's a very big change. So the assets of Chinese residents totally about 600 trillion yuan at the end of last year, and the financial assets totally above 300 trillion yuan. That is about 60% of the total assets. But the housing assets accounted for about 40%. If you compare this data with the US, the financial and the real estate asset allocation account for 70% and 25% respectively. So it's quite different. And another one is that the rapid growth of the wealth of the Chinese residents, because the local people, the Chinese people, become more rich than before. So there's more demand for the financial products and services. So investment target, beginning, they shift from the real estate, the banking deposits, and some of the rigid payment products to the other asset type, like the funds, like the hedge fund, the mutual fund, and etc. So the Chinese wealth management market become the new blue ocean in the next decade. And according to the data of the McKinsey, they estimate that China's personal financial assets will maintain an annual growth rate above 10% from 2019 to 2025. But last but not the least, the ongoing transformation in the market and the product structure offers new opportunity for the local providers and the foreign providers. For example, like the local public mutual fund. At the end of August of this year, the overall management scale of the public mutual fund was raised to above 23 trillion RMB, which increased over 70% compared with the last year. It is expected that the annualized growth rate will remain at about 18% by 2027. So it's a very big, huge increase rate. And another example is the security firms. I'm from security firms. From the structure point of view, the bond products are still the main products managed by the security firms, asset management, accounting for more than 60% in the first half of this year. And there is also an uptrend trend. But at the same time, the portion of the equity products allocation has increased very significantly from only 2% in 2018 to about 15% in the first half of this year. So the security firms in China not only have strong retail capabilities, but also provide more financial products to the market. So to sum up, I would like to say, because of the housing finance, the real estate goes down, and the Chinese economy shift their structure from the real estate, infrastructure, and then to the new economy. That will help the people, inhabitants in China, they shift their investment from real estate to the financial products. And that's a very big new change for the local market. So that will be very helpful for us, for all of us, right? Thank you, Mark.
Thanks very much, Dr. G. And I think I often warn people about managing risk in their portfolios, and risk can develop over time. And before you know it, your portfolio is different than what it was 5 years ago. This is not so much a risk story, but this is a story about change within China. I would definitely get, I'm sure many people who are watching us today are already well aware, but if you don't know China well, take a photograph every 5 years, because that gives you context of change. And context of change is hard to imagine, either the technology, the policies that are changing, but also, as you mentioned, Dr. G, the change in portfolios, the rise of the middle class, the rise of a savings culture around pensions, retirements, etc., plus the need to diversify portfolios. These are all very significant changes that have been well telegraphed for over a decade and are now coming through. So it is a very different market today. We do have some questions coming in though, so I'd like to just open up for the panel on the first question if I could. I think this is, to what extent is China's political economic system developing more consistent and transparent policies than perhaps some of the Western countries? I guess that's an opinion there by the question giver, but I guess they then go on to ask, is it a long-term perspective? Is that the difference that perhaps we're seeing in China to what we're seeing in other countries? And so I'm sure no one particularly wants to pick on a country, but is it the long-term perspective that helps drive China? Robert, would you perhaps like to tackle that?
Yes, actually, as for the transparency and the policy situation in China, I think there are two problems, two perspectives. The first one is that we have to recognize that China is a rapidly developing countries. For what we have right now, it is hardly being imagined back to 5 or 10 years ago. So the situation is new, just like just like what Mr. Deng Xiaoping said 40 years ago. This is crossing the river by touching the stone. So a lot of the situation is new for investors, for policy decision makers as well. And secondly, I think just in particularly this year, the policy plays a significant impact on capital market, in particularly for some sectors, as I mentioned, education, healthcare, and the property sectors. I think, look around the world, for any big economies, China has undergoing I think probably the most significant restructuring process for China's GDP growth. Because in the past 40 years, there's three main drivers, property sector, infrastructure, and export, right? But right now, the policy decision makers want to make it to a more consumption, domestically driven growth model. So, but I think it has to be a painful process. So, by saying that, I think the decision makers they do need to make more public, communications to make the policy well announced. But anyhow, just like Dr. Zhai said, I think the opportunity is that if you can understand and read the China's policy very well, it's also an investment opportunities. But the local, fund managers are very good at this, opportunities. So I think foreign investors can find more domestic partners going forward to do that.
Yeah, Mark, if I can just supplement a couple of points in addition, I think it's important to also note that global investors, in particular in the last few weeks, I've been in US meeting with institutional investors, really comment on a few things. Really, the plan is transparent. You just have to study carefully on the 14th five-year plan. And mainland government is executing on those plans that's been outlined by State Council. So for example, if you look at asset restructuring deals, in Shenzhen Stock Exchange alone, in IT sector last year had over 13 different asset restructuring with over 665 different M&A deals. And this is an industry that's fast moving, fast developing, and that's just not it. You've got consumer utilities, discretionary, industrials, and materials. Each of them have more than 7 to 8 different restructuring deals, and combining to overall mergers and acquisitions deals just in Shenzhen Stock Exchange alone of above 600 different deals itself, with the amount of over 300 billion RMB worth of M&A deals going through. So this is an economy that's executing against the plan that's been outlined. Carbon neutrality, the same thing. I mean, by year 2060, China is targeted to shift 85% of energy from fossil energy to renewable energy. So imagine the development that's going on right now in terms of the green industry companies. Pension plans, which I talked about earlier. The 14th five-year plan clearly highlights that by year 2025, 95% of the Chinese population has to be pension covered from current 91% end of year 2020 number. So this is a huge shift in terms of restructuring of the institutional flow into capital market, and that the publicly listed companies will be beneficiary of all this major shift of wealth from bank deposits to capital market movement. And certainly there has to be regulatory regimes around it, and speed to which the government and the regulators has to closely watch how this develops. But the market has responded as a result.
Thanks very much, Ty. I might ask you a difficult question, and that's just as a quick follow-up though. We have received a question about the role of government at the company level, the degree to which companies are influenced by government policy. CCP perhaps on boards is the perception that people have, but I guess you've already alluded to this. There's a lot of activity going on from the bottom up, isn't there?
Yes, absolutely, and we're seeing a lot of activities on both onshore in public markets, certainly private market to a large extent. International investors have been participating, so we're seeing this consistent development following the policy in place in Hong Kong. For example, for us, we've just concluded our public market consultation for overseas listed companies to list in Hong Kong, i.e. this will be for ADRs currently are listed in the United States. So we're looking to reform some of those listing requirements for those ADRs that are currently listed in the US to consider secondary listing or dual primary listing in Hong Kong, to help migrate some of those considerations that are taking place right now around the US regulation.
Okay, on that note, we're coming to an end, sadly. I think a couple of themes here is very, very clear. China does have clear strategies, and the strategies are very consistent. It's almost like an easy essay question for an undergraduate. What have China's strategies been? Because you can literally look them up, and you can, of course, assess the degree to which the strategies are being stuck to. And in my opinion, they've been very consistent over time. The other thing is that China is a growing market and developing market, and clearly a high technology market, emerging middle class, but also developing in terms of asset classes, which we've alluded to today. We've been unable to talk about a number of them, and it's definitely worth looking at them, but you know, a whole range of asset classes are developing there. So I'd like to thank the panel today. Thank you very much, particularly as I know it's late in almost every country that everybody's in there. I think Thai's in the US, but to all of you, thank you very much for joining us. And again, I'd like to thank Bruce and Jim for including China in the program. It's very, very important. There's no question that even if you're not yet ready to invest in China, or you've got different views on the current strategies, you do need to monitor it, because it's going to affect global markets and your global portfolio. So I'll hand back and say, you know, thanks very much for joining us on session. I think today's program looks absolutely fantastic. So I wish you all the very, very best for the rest of the day. And thanks to our panel. Thank you.
Thank you.
Thank you.